I tell you what, Drew, you've got a bit coming up ahead of you, mate. Hi, everybody, and welcome to your Trading Export. Hey, everybody, and welcome to your Sunday market update live with us right now. We're going to have a look at this market and get through it with a number of different experts as they dive into the market and see if they can pass on some wisdom and some understanding for you guys. First up, as always, will be Julian. Is going to have a look at the macro stuff. We'll have Alexis in for fundamentals. We'll have Ash in for data. We'll get into gold with Ainslie. We'll get into crypto with McCree. We're going to oil back with Ainslie. We will have Lloyd come in and do currency overview. He'll look at it like from the dollar index, but everything's indexed, and talk about how they're working, how he uses that to trade profitably. And Geoff will come in and give the technicians 2 cents worth later in the session. So it's going to be an amazing 45 minutes or so. So jump in, enjoy it, and learn as much as you possibly can. See if you can find a few directions for next week. I've got to say, Julian, I put this on record last week. I think it's been the worst 2.5 weeks of market as a trend trader I've seen since about September 2015.
I'm going to struggle to argue with you on that one, Paul. I think that, so two things happened last week when we look back at last week, right? We had the breakout, if you like. Can we say the US dollar rally? And I'm going to call that the beginnings of a breakout. And closes above multi-day closes, looking like it was going to go higher. And then non-farm payrolls came in, and they came in, well, I'm going to say about on target. Although that these days, if you miss by 100,000, that's about on target. Oh, how the world has changed. Despite the ADP report earlier in the week showing an initial claim showing a much bigger uptake. So look, I think what was really interesting about that was that we saw the bond market rally a little bit. Yields came off a fraction. We also saw, as a result of that, a rally back in gold, a rally back in oil. Oil kept on going higher. And for the currencies, if you like, I hate using the words risk on and risk off. So let's just say the US dollar had a bit of a rough day. Having started out on Thursday with a possibility, a strong possibility of a new direction. That was not quite almost totally reversed, but pretty much most of it was reversed on Friday. So where does that leave us, right?
Mate, one final thought before I fully pass to you, mate. Hasn't it been 2 weeks where every time you get in a direction, it doesn't go that way until you stop, and then 3 days later, bang, it's on its way. And it's just been it's been hard to pick up the right signals and hard to pick up the direction. Mate, I'm only making some chat. Let's hear some macro expertise from you, mate. Over to you.
Yeah, look, and you've nailed it, Paul. And I think, look, this is the key problem. But we go through times like this, right, folks? This isn't the first time the market's got a bit more abundant. It will not be the last. I guarantee you that. If you're a trend trader, you had it pretty good in November, December, Jan, Feb, and then the market since then has quite a few of the currencies just gone sideways, right? So when we're looking about interpretation, last week we had this conversation about the 3 main themes. I'm just going to remind everybody about those one more time, right? So number 1, government spending. Number 2 is the inflation rate and all the hullabaloo about inflation. And number 3 is the pandemic and the changes that are going on there. There's different rates of change of the pandemic and declines and increases all over the planet in different places in different ways. So where I think it's really important, and I continue to stress this, is if you're going to have a view on the fundamentals, the view on the fundamentals will have to be how you'll have to have a view on those 3 things, because those 3 things will drive the outcome of the markets going forward. And that will give you, if you like, a little bit of a trading edge to either trade more aggressively perhaps, or to be more hopeful about and express that through your trading around the trades that you have in a particular direction. So at the moment, when I'm looking at this, I continue to see the Citibank Economic Surprise Index in the markets across the world underperform. I.e., what's going on with that is economists are being now in the space of over predicting what's going to happen on the good side, right? They said, it's going to be 1 million people will have found work last month. Well, actually, it turns out to be only 500,000 or 600,000, right? And so this surprise now is hitting the negative category. So we've had 3 or 4 months where the Citibank Economic Surprise Index has been in the positive camp. in positive territory, and now pretty much around the world it's moving into negative territory, which is a very interesting thing. So when we talk about rates of change, what I mean by this is why this is important, right? Now, why is it important? Because when you think about what's in the market already, is what those economists have been telling all their customers, right? So when there's a surprise to the top side, you can construct an argument that the world is doing better and therefore stocks should rally, gold should rally, oil should rally, things should go up, right? Because they're in more demand when things surprise to the upside in the economy. The flip side is when things are starting to surprise the downside in the economy, it wouldn't be too far to reach to say, actually, maybe the opposite needs to start happening. So again, caveats everywhere, because, we're traders. We've got to trade it as we see it. When that starts to find its way through to the marketplace, because right now I don't think it's being discounted. But what is happening is the dollar is pausing, or these markets are pausing, right? They're seeing that surprise go in the opposite direction. They're going, oh, well, now I need more evidence that my thesis is correct, right? The governments will still spend money, inflation will still rise, and the pandemic will get better, right? Fewer people infected and lots more people recovering, more vaccinations and all that stuff. So when you're thinking about this, what's really important within all of this is to try and think about those three things: the rate of change that's going on, and then what's that doing to the market. So here's the thesis, right? Until we have a significant shift on the liquidity fronts from governments, I suspect that we are going to continue to see the US dollar probably trade poorly. So here's the thing, right? We need to keep an eye on that liquidity. Now, how do we do that? Well, there's a number of different ways. You could look at inflows to stocks. You could look at the savings. You could look at the treasury balances, the government balances, the US federal government balances at the treasury and things like that. There are ways to measure that liquidity and have a keyword, right? Have that keyword on Google and just keep looking up liquidity and see what it says, right? What you're looking for are clues that says something has changed. Until something changes, the world is still spending money. The world will carry on with the existing trends in one form or another, and I would expect us to continue for the Australian dollar to possibly continue to rally, and for the Canadian dollar to head towards that 118 level we all think it ought to get down to. And all of those things will continue to happen, right? But if it's going to reverse, if we're going to have a change, then what that change is going to come is going to be in the subtlety. It'll be in that rate of change. So the government stops spending as much, right? More people get vaccinated, or it slows down, right? The Asian rise in the Asian rise in infected cases gets worse, right? Not just talking India now, but Indonesia, Malaysia, Vietnam, Korea, they've all got a rise in cases going on at the moment, right? So we need to be on top of that as well too. Is that going to get any worse? Don't forget who makes the world's stuff, right? It's usually made by most of those Asian countries. So these things are quite important. Keep an eye on them. Back it up with the technical picture you're seeing in the charts, and get out there and trade it. But in the meantime, if you're not sure, you don't see what's going on, and as Paul says, it's a quiet time and the markets are sort of going sideways, understand that two things are going to happen. If you continue to try and trend trade, in all likelihood, your performance isn't going to be that good. But that's sometimes the price you pay for continuing to ply your trade in the marketplace. If you have a range following system, you absolutely have to maximize, right? Range trading right now, you've got to maximize those results, because while it's doing this, you might not have the time to do that at a later stage. So that's really sort of where I sit with all of this. No real key changes at the moment, but we're watching really closely that US government spending. And stop hearing about all these dream numbers and wait till we actually get something written on a bit of paper is my advice around this. 4, 5, 6, 7, who knows how many $1 trillion the Biden administration is going to spend. And actually, quite frankly, nobody really cares. What people care about is what the expectations against the actuality is, because that's far more important to markets. One last point I will make. The bond market I respect in the same way that you respect the best trader that you've ever seen in your entire life. Okay, the bond market needs to be treated with respect. Right now, with bond yields at 1.5% in the 10-year and falling as they were last week, right? Do they believe in inflation? I'm going to leave you with that question. Thanks, Paul. That's it for me.
Cheers, Julian. Interesting times. Looking forward to next week. I just get the feeling that, every week we come back here and talk about different things, and sometimes the market's performing in a way where the macro view is just really clear. and sometimes it's just a bit more confused and a bit harder to follow, and it just takes a minute and this kind of stuff. So you just keep listening every week, guys. See if you can understand the language and see if you can understand the theme, see if you can understand the thesis. The more you do it, the more you'll get it, and the more you get it, the more money you'll make. And look, there's no magic formula here. It's like anything else. You start at the start, you end at the end, and in the middle is turning up every week and getting better at it. So thank you very much for it, mate. At the end of the day, it's masterful. Thank you very much for it. Much appreciated.
Hey, one last point. Sorry, if I can just jump in. So Lewis has asked a question. Am I okay to answer this?
Yeah, you are. It's fine.
Yeah, look, so Lewis, the interesting thing about non-farm payrolls is don't worry about the month-to-month changes, okay? What happens is the economists try and guess those month-to-month changes. Sometimes they get it right. Most of the time they get it wrong. That's just the way life is. What's really important is what those changes are on any one particular month. Sometimes they revise the figures from last month a little bit up, a little bit down. Most of the time those revisions aren't very big, but what we're seeing right now is massive volatility in those numbers. Last month we had, what, 250, 270 something, I think, for non-farms. They're expecting 1 million, right? This time it was meant to be 600,000 and they got 550, I believe. I can't remember the consensus, but they were lower again, right? This is really odd. There are strange things happening, but at the end of the day, yes, you're right. Double the number of people got employed last month compared to the previous month. But this just goes to show how volatile these numbers are, and actually how bizarre it is to try and figure out what those numbers are going to be each month. I think it's a complete crapshoot. I have no idea how anybody knows roughly what the numbers are. I think they're just making them up. So the short answer is look at what the economists are predicting and then see how the markets react to the change. That's the key message.
It's fascinating, isn't it, Julian? Sometimes I consider non-farm payrolls to be the biggest non-event in trading. They can go 6, 7, 8, 9 months where nothing happens, right? And then all of a sudden there's a bit of pressure on and they start, getting those numbers badly wrong. And all of a sudden it's back just running the market for a period of time.
Yeah, look, and for those of you who've been with me for a while and listened to some of my speeches, I talk about lagging, leading, and coincident indicators. Unemployment is a lagging indicator. When you hire people in a business, okay, you are not hiring people in expectation of work that's going to arrive. You've already got an overworked staff. That's why you hire people, right? Because you've got too much work already, which means by definition it's a lagging indicator, right? What would be better is to look at what the factory orders are and what the PMIs are showing for all those industries. That's a leading indicator. Those are the ones we should be thinking about if we're looking for economic direction.
It's interesting, isn't it? Because unemployment, they're seeing that go in one direction, they're expecting unemployment to follow, and it's not. And it's just freaking them out a little bit, right?
Totally.
Cheers, mate. Thank you very much. As always, we will see you back next Sunday night, mate.